Hey traders, welcome to a global macro update. This is going to be part 2. The first one we did, we were talking about the SPX and also the US dollar index. In this video, we'll be going over the commodities, mainly gold and silver. We will look at the chart of US oil, but we won't really look at any fundamental factors or any news stories relating to that. So the first thing we're going to be looking at is talking about MMT, or modern monetary theory. So Bitcoin and gold bugs, or Bitcoin enthusiasts and gold bugs, actually share a lot in common in terms of what they see the outcome for the Fed and this whole money printing Keynesian economic monetary system that we have. And at the end of the day, what are they thinking? They think that there's going to be not just inflation, but a potential hyperinflation due to the basically unlimited money printing that the Fed is currently implementing to try to curb the deflation, try to buy up assets, and really try to stop what is a normal cycle like bear markets, bull markets. There are seasons, there's winter, there's summer, there are minor capitulation cycles, there are cycles in almost everything, and what they're trying to do is basically change Mother Nature, change what nature really intended, and basically never have a recession through MMT. So what is this? Enter so-called modern monetary theory, or MMT. As others have pointed out, there's nothing modern about this theory, but it's still music to profligate government ears. MMT provides intellectual cover for printing all the money they want. That's basically, when it comes down to it, they can buy up their own debt with the currency they have, so they can just keep it full circle, keep on buying their own debt, and they think that it's possible because they look at Japan, and Japan has been doing it for decades, and obviously they're still a first world country, and they've been in a deflationary spiral for a while. A lot of things with the demographic cycle, with like not even close to as many kids as there are elderly people, so there's less jobs and stuff. But there's a lot of people who are now actually saying that MMT could be a possibility. Dan Elpert is the guy who actually didn't create it, but he's a professor at Cornell, and he's a proponent of MMT. He's an advocate for basically unlimited money printing. And he argues that experience since this crash of 2008 shows that governments, at least some of them, can print all the money they want with no adverse effects. Now, this is only 10, 11 years since they started quantitative easing and this whole money printing craziness. And in my opinion, that's not long enough to see the cause and effect relationship, because right now they're just printing more and more money. They don't have, 150 years of data. They have, let's say, the years that they did QE. And if you're really looking back at historic monetary policies, you can see that unlimited money printing cannot work. Debasement of currency will inevitably create the value of that currency to zero. And this is a individual from Kitco, Lobo Tigger, I guess his name is, and then he had some good points for the flaws of MMT. So let's read them now. So the first thing is Keynesian economists and people within monetary policy hate deflation. I personally don't know why. And I agree with this statement. There's nothing inherently bad with deflation. It just means that goods and services are getting cheaper, which means the cost of living is going down. That is a good thing too. Now also, what is also causing deflation is the advancement of technology. I recently listened to a podcast, I don't exactly know who it was, but the individual was talking about how the advancement of technology is inherently deflationary. And we can see they have this example as well. The deflation has been started basically by the invention of the Hand Axe. So with new inventions, with technology, that is going to speed up the process, that's going to make something more efficient, and that's going to lower the cost to actually produce it. And if you have a business and your cost is lower, you're going to sell your service or product for a little bit lower than the next guy, so then you get more business because you can. So it's, in my opinion, something that should be welcome to some degree. And I don't really understand why policymakers think that deflation is the worst humanly thing possible. Next thing is the MMT excuse for money printing strikes me as very US-centric. Only the US dollar enjoys status as reserve currency of the world. No other country can just print money and use it to pay for imports the way the US can. So yeah, because the United States is the reserve currency of the world, they have obviously the most power when it comes to being able to print what they think is value or worth, which in my opinion, it's not. Over time, I think it will definitely weaken the US dollar. For now, obviously with so many things selling off, with the US dollar being a world reserve currency, if someone is selling coffee, oil, gold, silver, they're gonna have to buy the US dollar. It's a pair, so they're putting demand pressure against the US dollar, which is pushing the price up right now. And that's great for the United States. Why would they want to change that? They're benefiting from all this, right? Even in the United States, and despite the Fed paying banks to maintain excess reserves, reducing the volatility of money in the economy, there has been extraordinary inflation since 2008. But it's just been concentrated in the financial sector. So in 2008, governments gave the bailouts to the banks, and the banks just kind of got to do whatever they want. Maybe they loan it out to people, maybe they buy stocks or equities or go into debt structures, but they do something with it to try to stimulate the economy, get the money flowing. But this was really only seen on Wall Street. Real estate and equities saw huge overvaluations, huge inflationary pushes in value, but we didn't really see any of that inflation in everyday goods and services because the money didn't actually end up hitting the everyday citizens in the United States. But this time, it's different. A great deal of flood of new money is going directly to consumers. That makes it reasonable to expect inflation on Main Street as well as Wall Street. I completely agree. They're obviously sending $1,200. I don't know if it's $2,000 a month, but they're sending money. Universal basic income is being implemented right now. They're even talking about the Fed coin. That's a whole other subject, but they're trying to find more efficient ways to send money to individuals. And this is, in my opinion, going to create inflation because they're sending it to everyday citizens, and that increased supply of money is going to be targeted towards everyday goods and services, and obviously that causes inflation. And then the last thing that we're going to be touching on, the COVID-19 disruption wasn't just to our jobs reducing the demand, it was the supply as well. Factory shut down, farmers plowed crops under, dairy farms poured millions of gallons of milk down drains, and miners producing the most basic raw materials shut down. Some of this production will never be replaced, and more dollars chasing fewer goods is inflationary by definition. So I completely agree, and a lot of the Bitcoin enthusiasts and gold bugs are, I think, having a similar vision and similar outcome. It's just they have the change of, or they have a difference of opinion as to where the actual money is going to get funneled to. Obviously, with the digital age, I'm a little bit more on the cryptocurrency side, but I do think that obviously gold is a huge asset to be in within the next handfuls of years here. Just looking at the CPI, this is the Consumer Price Index. It is posted or updated on a monthly basis. And what it shows is the increase in a percentage basis for the cost of everyday goods and services. We can see the Consumer Price Index for all urban consumers is a measure of the average monthly change in the price of goods and services paid by urban consumers between any two time periods. And we actually saw some deflation. So when the chart is going up, you're seeing inflation. Prices of goods and services are going up in value. This is 2008, the financial crisis, from let's say from July all the way until December of 2008. It was pretty deflationary. Those costs of goods and services were going down. Soon after that, we saw the price go back up and then surpass the previous high. Now, this is only for March, so we don't have this current month's data, but we see deflation. Give me some water, give me one moment here. We're seeing deflation, so the prices of goods and services for all urban consumers on average in all major US cities is going down. So it's actually deflation right now. So theoretically, you're not really going to see a huge demand for safe haven assets mainly for like safe haven assets due to inflation, where I think gold and Bitcoin enthusiasts are more targeting of QE's bad, there's going to be inflation, this is a fixed supply, you can't just create gold out of thin air, you can't create Bitcoin out of thin air, you have to mine it through the ground or through solving very challenging mathematical problems, but you're using energy to create value because it's an exchange, right? And it's not like you can just print unlimited amounts with no value add or no energy put into it, because the way I look at money is it's just a hold of energy. You can do what you will with it, and US dollars is a terrible way to hold for long periods of time, but it is a means of holding energy which you can actually purchase real life goods and services through. And then that's basically it for gold. We will talk about silver. We have one more discussion to talk about silver. But first, now let's look at the price action of gold itself. So let's go back to the 6 hour. And actually even the daily, because that's probably pretty important. Just to go over, I look at this every single day, so it might not be something that you do. So let's take everything off, get our snip, and then discuss what we're able to understand within the price action of gold on the daily chart. So first things first, number one, we can obviously see that $1,700 zone is a strong level of resistance, which is now going to be a key level of supply. Or sorry, support, not supply. It's previous resistance, new level of support. That's like the most simplest thing we can see. Also, we do see a nice ascending zone. We can draw it in two different places. We have one right here that is holding, but if we actually want to draw a larger one, we would get the anchor point from here. We see some higher lows right here, and gold actually broke below it, so it is testing the sellers and seeing how much confidence the sellers have within the market. I also did draw an ascending zone, so it does look like a little bit of a wedge, kind of like this. So it does, to me, seem like we could get a little move to the downside to test the strength and confidence from the sellers. Just because it broke a support doesn't mean it's going to go very far. All it's showing me is it's testing the strength from the sellers. And right now, we're wanting to see if it's going to hold this zone. We said in the previous video that we are looking at around the $1,700 zone for a possible entry, because we had a very clear higher high that broke the previous major high. There's a significant break, and every push usually comes with an exhaustion, maybe not retesting exactly, but the market moves in waves, in impulse and corrective moves. So this is the impulse, and the corrective moves are to the downside. We were waiting patiently for the corrective move, and now it has come into fruition. So now we are having a bullish bias due to the fact that we have a strong uptrend for one, a lot of uncertainty in the markets, and we've recently broken a key zone within the chart right here. And just looking at the fundamentals, obviously it's extremely bullish for gold because it's a safe haven asset and there's a ton of uncertainty within the markets. Now let's go into the smaller time frames, because we've discussed the key areas that we are looking at within gold. Let's just put all of our trend lines in and then go on, let's say, the 6 hour, and then we can discuss a little bit more as to where we think that this could go. All right. So looking at it with the trend lines and a little bit more clear of a view, we see that this ascending trend line did get broken like we stated, and then we see that the previous resistance at 1700 is now getting tested for a new level of support. So right now we went from an uptrend to a consolidation right here, and then we're now testing to see if we're going to hold the consolidation or if we're going to break down from the consolidation. So in that said, let's go in right here, because right now I see the market as going sideways, which in my opinion is not a bad thing to do, because if we are looking for entries at these lows here, going at a consolidation is a pretty good structure to be in. Let's go on the 4 hour and zoom in a little bit more. All right, so the price broke the ascending zone like we stated. And right now, because the price broke the ascending zone, in my view, we're now testing the strength of the sellers. So we got one pullback, and then we got a rejection from the sellers, pushing right back down. Now we're getting the sellers to try to push the price below our key structural support. And if we see the price hold, that is going to tell us something very, very significant. Because in my view, we're testing to see the seller pressure, the sell pressure, to see if the confidence from the sellers is able to push the price down. If it's holding this support zone, that's a very important thing to understand, because at the end of the day, if sellers aren't able to push the price down, you're going to get a shift in confidence from the sellers to the buyers. So then to actually discuss actionable items, let's just zoom into the 1 hour. This is the execution time frame that we are going to be using. Going to get a little bit of water and then we'll continue on. All right, so what do I see with the market right now? After breaking down here, we see a support hold 1, 2, 3. So now I see the market within this consolidation right here, where I see the support at around 1685 and the resistance just above 1700. So right now we're going just in a sideways consolidation. I personally don't really want to be longing at the lows here, because we do see a lot of attempts to try to push the price down. You see a major bearish engulfing candle right here. You see quite a bit of engulfing candles throughout the chart. So definitely there are sellers within the market and I want to be cautious. But at the end of the day, I am bullish on gold, so I do want to look for some long opportunities. So the trade that I'm looking for is I want this support to hold, and I want to see the market structure change from a consolidation sideways, where we're holding a resistance and support, to the price breaking the resistance, making a clear higher high, and I want to enter on the higher low, testing the previous resistance right here as a new level of support. That, in my opinion, would be the best opportunity, because we got the price to break the ascending zone to the downside. We see the price testing the support yet again multiple times. If we see the price test and hold the support, that's going to give you a lot of information that buyers are just not pushing the price down. The buyers are not letting the price go below a certain level, I should say. And we see a lot of wicks here where it's pushing down, but then the buyers are pushing it right back up, which in my opinion is pretty bullish. But for the highest confirmation, the highest probability situation, I think that waiting until this consolidation is broken to the upside, where you have a nice area where you're testing the previous resistance as a new level of support, would be the highest probability for us to start going back and moving to the upside. And if that's the case, in my opinion, that's a really good opportunity for a potential long. Now, let's say, here's another option. Let's say we actually don't break the $1,700 level of resistance. So right now we're still in this range like we talked about. And if we actually break to the downside and we don't break to the upside and test for a new level of support, well, then we have this minor white trend line right here, which is in confluence with our previous resistance, new level of support, which we can clearly see on the daily, like so. And let's just make it a little bit bigger so we can see it. So we got our first anchor point right here. And then we have the candle closure. So that's a type B candle closure, where you see a wick protruding above the zone, but you see candles closing right at this area. And then for the third time, you see second time, third touch, you're seeing another type B candle closure, where you're seeing wicks push the price, or wicks go above the price or trend line, but the price is pushing back down and closing below the key resistance zone. So then if we connect the three zones, we see that there is a level of confluence here where we're holding a previous support and resistance, as well as that descending zone we just talked about, creating a nice potential opportunity for a long there. So if it does fail to hold 16, let's say 85-ish, 1680, then we'll probably be looking at 1650 for a possible entry for a long. But yeah, at the end of the day, I am looking for longs for gold, because I'm very bullish on gold. But just breaking this ascending zone, I think it wouldn't be too surprising if we did see a little bit of a move to the downside. But at the end of the day, I'm just waiting to see if the price is going to hold this 1685 range, and then continue the consolidation, and then break the resistance. That would be a good opportunity, and then it would look something like this. So let's get our trade plan. So you need to see the price clearly break the zone, retest for a new level of support. We could have our stop loss being pretty generous within the entire consolidation. We'll probably have a higher low before we actually break it, which then would allow you to significantly reduce the risk. And then your first main zone that you're looking for resistance would probably be 1790-ish if you are trying to go for that next major leg up, which looking at the daily chart, we can see if we zoom back out, in my opinion, the next main key level of resistance we can see with the 3 highs here is going to be 1790. And then if you're ballparking, the $1,800 range of supply is going to be the next major zone where we're going to have a battle between the bears and the bulls, in my opinion. And the high that we've seen ever really was 1900. So that is going to be the major level that we're going to hit, but $1,800 is a significant zone that we will, I'm sure, have some battle within this range. So that's going to be my analysis for gold. Going to be pretty patient here. We do see that it's dipping down below a little bit, but at the end of the day, we will need to see basically the price come all the way down to like 1650s-ish range, or break the $1,700 level of resistance. But we're definitely not looking to short gold. We are not looking for short exposure at all within the precious metals sector at this point. We're just looking for good opportunities to enter long. That is the gold analysis. We'll then look at silver because I kind of had it a little bit wrong. We'll talk about it right now. This is by another individual from Kitco. Contrary to what many might believe, silver is not always a leveraged play on gold, especially not during a recession, the analyst at Refinitiv added. Refinitiv, I guess. The analyst noted that over the past 7 U.S. recessions since 1969, gold has seen average gains around 23%. Silver, however, has historically performed as an industrial metal during these periods, having sustained losses during most of these recessionary periods at an average of only 1% gain overall. That's pretty surprising. The analyst said that the global economy is already in a recession. I completely agree, with the Federal Reserve responding with plans of unlimited quantitative easing. The narrative is always that with QE, gold is going to outperform, and you need to hold it and nothing else. I don't really agree with that, but let's go on. That might work, but also you have to bear in mind that these assets tend to trade not always in a straight line. I do agree with not everything he says, but he does make valid points. And the last thing we're going to read right here. We believe that in the short term, gold remains vulnerable to further losses, particularly if the COVID situation continues to deteriorate in the US and some parts of Europe, and if we see another meltdown in stock markets, which would inevitably lead to gold liquidation. So remember last time, the huge sell-off in gold, which would be, let's just go back to the 4-hour chart, this huge sell-off back in kind of mid-March. That was because the stock market had a massive tumble and basically almost every single asset across the board just absolutely dumped because people who were over leveraged, had margin calls, and they didn't even actually physically have gold to even sell. You could have contracts and sell, and that would obviously still put sell pressure within the market, and that's what we got there. Is a lot of margin calls, a lot of people getting liquidated, and then you get a huge sell-off. And it wouldn't be surprising if we got a massive sell-off in the stock market that we would get something similar within the commodities market. So now let's look at the price action of silver. One thing to note about silver is gold looked particularly bullish on the weekly chart because we saw a series of higher lows, which in my opinion is pretty bullish, and we saw a horizontal level of resistance at around 1400. So on the weekly, we can see that we got a series of higher lows. Low, higher low, higher low, higher low, which is really bullish, and we saw a horizontal level of resistance. On silver, we actually saw lower highs, and we've talked about how the different structures kind of present a different bias as a trader, because if you're looking at the weekly, lower highs is a lot more bearish compared to higher lows and a horizontal level of resistance. So silver for me wasn't really too much of a buy. It was actually more of a potential short because of the larger weekly time frames that we're viewing. Now, yes, they are both precious metals, and I do think that once the worry of inflation does actually hit everyday individuals and you see more speculation within the precious metals market or sector, you will see silver appreciate in price as well, because if we zoom back into the weekly chart, we've seen that silver has obviously been an unbelievable gainer in some circumstances. Just looking at September of let's say August of 2010 until April 2011, we saw the price go from $18 to $47, $48, let's say, which is around 166% in a very short amount of time. So silver is extremely volatile compared to gold, and we can see it absolutely explode, but that's just mad speculation. I don't think you're going to see that for very well. We're still in the consolidation, making series of lower lows and lower highs, because if we're looking at the weekly, we can see that we are still making a series of lower lows and lower highs. High, lower high, lower high, low, lower low, lower low, lower low, lower low. So we're still in that downward consolidation. Yes, we did get that little pop from this squeeze that occurred within the market, within this zone, and then we saw horizontal support, and then we got a little squeeze. We just tested a nice resistance, and then we absolutely dumped back down. So definitely not looking very bullish for silver just yet in my personal view. And then if we are just looking at market structures, this is a support here, and then although we did push up above it, it kind of does look like it's a slam down, a pullback, and then maybe testing these lows. That $13 range, or sorry, that $12 range is pretty good for a possible level of support. So if we do see any sell pressure start to come into the market, I wouldn't be too surprised if we get quite a bit of a sell-off in silver. And that said, it does look pretty similar to gold if you look at the 4-hour chart of both right here. So we can actually put an ascending zone within silver as well. That's just connecting the higher lows, which would be like this. And then we can see that it broke below the zone. So now we're getting a small series of lower highs and lower lows. And this around $15 range is a key zone for the price to break. If it does break below there, I definitely see a potential head and shoulders that could come into play. If you're not able to see it right now, here is the left shoulder. Oh, that's an 8. I'm supposed to put an S. Left shoulder, and this is a head, and this is the right shoulder. So then I'm sure you can see it at this point. That would be the potential opportunity that we'd have, and then you could be looking at an entry at the right shoulder or a potential break in a horizontal zone with a retest from previous supports into new levels of supply. So you got a couple options here. I don't think it's ready to really enter at all in my view, but I'm mainly looking at gold more because it's just more it just looks better in terms of the market structure. You see gold not really consolidating nearly as much, where you're getting these strong trends to the upside, but silver has just kind of slowly died off here, consolidating sideways. So if we start to see some movement either to the upside or downside, I'll be a little bit more excited. But right now, within this just kind of flat, dead consolidation sideways, I'm not really looking to gain any exposure. All right. So talking a little bit about the gold and silver ratio, we can see that, well, first off, let's go all the way to the weekly chart. This gold-silver ratio hasn't been this high in decades, and some people are saying centuries or ever that they've known, and they've been gold bugs for a while, which is pretty crazy. But just because something is going in one day doesn't mean that it's going to immediately turn back. And what this chart represents is for 1 ounce of gold, how many ounces of silver can you get? And this chart shows that right now you can get just under 111 ounces of silver with 1 ounce of gold, which is just looking at historical averages, making silver extremely undervalued. So now let's look at this huge pump that we saw. Very simple TA. We have a nice trend line right here, and then we have another ascending trend line. You could put it at different areas, but I got this little nice wedge here, and then it had a massive, massive blow off top. And then if we look on the smaller time frames, we are basing where we're holding a nice zone. Like here, if it does break, because we are still not broken the market structure, we see that high right here, still not broken, which is the structural high that I'd like to see. Come on. I'd like to see break before I have any sort of potential bias of it actually trying to test these highs again. So it's kind of looking similar like this. So if we see the price, let's just go like this. So if we see the price break the support, we're probably going to get a next leg down to form a lower low. We can see we are still forming these lower lows here, and we just still are forming these lower highs. So right now, we're still kind of going on a downtrend. If we see that next leg to the downside, this means that we could see either gold go down and silver remain relatively stable, or we start to see silver actually go up and then gold remain around the same, or we could see both go up and then gold just doesn't go up as much as silver if we move to the downside. So we'll see how it plays out. Right now, in my opinion, it just looks like it's forming a series of lower lows and lower highs, which is a little bit more bullish for silver. But like I said before, I am looking mainly at gold for longs, and I don't really want to enter long on silver just because the market structure, the price action doesn't really look positive to me, pretty honestly. Gold just looks like it's more healthy. It has stronger bullish pushes to the upside. It's showing more like zip and more of a lively kind of price action where it's really bouncing. The bulls are really pushing the price up, whereas silver is very lethargic in terms of the pushes up, it seems like. Kind of hard to describe characteristics, but I hope you kind of understand the structure, how the candles are formed, the bullish pushes of the market. They're different price action structures, so I'm going to trade them as such. But that's my view on the gold and silver ratio. We'll see how it goes. I'm not super focused on silver just yet. I don't really love it. I'm more interested in gold. Last thing we're going to be going over is WTI Crude Oil, or the ticker is US Oil. I currently am not trading US oil too much. I'm just focused on other things. Obviously, you can't trade every single asset class, but let's just still go over it because I know some people are interested. So first things first, where did we get this green trend line from? On the weekly, we have a very, very long-term, well-respected descending support that we initially tested back in June of 2004. We tested it as a low after that massive crash in 2008. And then we see it test again after that massive crash in 2014. And then yet again, we're testing this zone. But, you know, if we actually break this zone, we're probably going to be hitting some massively low numbers here. I'm thinking like $13 per barrel, or like $13 to $11 per barrel. That wouldn't surprise me at all because we just see an absolute dump in price here. And if this is not the support, which is in confluence within the low of November of 01, we can see that that's a nice little area of confluence for support. If we break, let's say, the $20 range, where there's going to be demand around $20, we could definitely go back to like $11, and we haven't seen those levels since 1999, which is unbelievable. But yeah, it's if you think that commodities aren't volatile, you haven't seen the long-term chart of oil, because we've seen absolute market cap decimation, 75%. You're seeing another 75%, and then recently you're seeing another 70%. So, you know, 3 times where you're seeing absolute decimation of market cap, which is pretty crazy. So now talking about the smaller term time frames here, we see that nice zone of confluence. I will take out this because we already know that the $20 range is a strong zone of demand. Now looking at the 4-hour time frame, we had this nice consolidation going sideways. Let's go like this. And we initially said that we could get a squeeze here, but when the price was around this range, I said it's way too early to look for a potential long opportunity. It would make sense because you got 1 touch, 2 touch to get maybe 3 or 4th. Then you have that confirmation of the support holding multiple times yet again, and then you have that key descending trend line that's going to squeeze the price into the apex of the pattern. In my opinion, well, I at least have a good edge trading those, so I would have waited for that, and this just, in my opinion, wasn't enough confirmation. But we did get the sellers to push the price down below the support. Now, in my opinion, it's just too early to be shorting right now. I would rather wait until there's some level of confirmation of the previous support turning into a new level of resistance. And that would mean that we're going to get the price to come back up here. It could just instantly dump down, but in my personal view, I think that we will get some consolidation, because we could argue that this is, oops, that was a really poorly drawn line. You could argue that this is a low, lower low, lower low, which is just a descending trend line connected like that. You could do something like this. So this could look like a huge wedge here, and then it could start climbing back up. We don't exactly know, but I'd say it's definitely still too early to say, just from the break of the $20 zone, that we are gonna go all out shorts and say that this is just gonna absolutely dump down, because this trend line still is a valid support level that I would take into consideration if I was looking at this for a possible trade. So we'll see how it goes, and then this is obviously a very unconfirmed trend line, but we see the wick touch and then the candle closure on the 4-hour time frame, which does provide some level of validity and dependability for this particular trend line. So I currently see a descending wedge, sort of. I'd like to see the resistance get tested maybe one more time, if not two. That would really make it a dependable zone. And I think by this point, we have a strong level of demand, not only from the horizontal zone and the descending zone within the 4-hour, but also looking at the weekly chart, understanding the major key lower lows that we're currently seeing. So yeah, if I was trading this, I'd be a little cautious for shorts. I think it's kind of at the end of the extension move down, because we haven't really seen a massive push to the upside. This was just a little impulse move from short sellers taking profit off, but we haven't really seen any major short squeeze within the market in my personal view. So I think if we do get this to continue downwards and then this descending wedge to form, we could get another spike up around from the maybe $20 range back up to $28, which, you know, if it presents me with that opportunity, I might enter it just based 100% off the technicals and just keeping up with the news, but we will see how it goes. I don't really have any actionable items for US oil. Just, you know, you don't have to enter every single day in order to be consistent. It's actually probably worse if you try to enter every single day, a lot worse. So that's my analysis on the commodities side of things. If you'd like to know my viewpoints on the S&P 500, on the US dollar and the strength compared to other Forex currencies, we do an analysis on DXY, which is the US dollar index, which you can find within our YouTube channel, which we can see right here. Does the S&P 500 still look bearish? In short, in my opinion, yes, it still does. If you find our videos helpful, educational, entertainment, if you find them entertaining, you can definitely subscribe and find more videos as we make them. So thank you very much for watching. I will answer every single TikTok question and YouTube question. Now I will close the recording, but yeah, ask all the questions you'd like and I'll be happy to give you my 2 cents. I'm not a financial advisor. I do not give financial advice, but just take this as a random person on the internet giving you his 2 cents, who's really active in the markets, who absolutely loves trying to find high probability situations. But obviously, this is not financial advice. So I will close off this recording. Thank you very much for everyone watching on the YouTube. And until next time, have a good one.